Again. Everyone can see the screen, I believe. Um, so, so yeah. Today, thank you for joining us. May 28th, 2025. This is the Theta Alpha Fund monthly update call. Omar's actually has a conflict this afternoon. I think so does David as well. But this is Matthew Todman, and I will be speaking about the fund that and what we've done in the past and what we're looking for into the summer months. So our current theme, guys, is summer volatility. Okay, and typically speaking, you have like a good set of months going, starting the new year, the January fact. February is usually a decent month, so is March, and then we tailor away from that into the summer. And sometimes there's a little bit of volatility. Now we didn't really have that in the first few months, due to basically the tariff headline dominating financial markets in terms of where things are going. But we're kind of hopefully seeing the tail end of that, right? Now, looking to the summer months, we want to examine, what does kind of the volatility profile look like? And also, what are we going to do about it? So we can kind of take away the noise and just simply look at the facts. And the last thing we're going to do is, what do we have? What's our outlook for the next few weeks as we trade through the portfolio? Okay, let's continue on here. Um, so this is interesting. For summer volatility, you're seeing here, a history of volatility, January 1990 to 2024. So that's what, 35 years, right? And we can see that, yeah, there is a bit of a spread there. And, just as, nature follows certain patterns, so does the stock market. Now, during the summer months, June, July, and August was the typical summer months. Both realized and implied volatility often tend to settle into a bit of a dull period. And this is kind of a little bit opposite of what we're saying in terms of summer volatility. But like lately, we have been seeing a little bit of a market pickup. And that's kind of the thesis here. It's like usually now, like not usually, but like if you look at history, sometimes you see a bit of a dull period in volatility during the summer. And what happens that we've observed in the past is that September and October, certainly make up for that volatility slump that has kind of built up during the summer, right? And focus specifically on summer months, June, July, and August, realized was 14.4%, and the average VIX was 18. And VIX is a kind of implied number, so a forward-looking number. So let's call it 14.5% and 18.5%. We do know that the volatility is a mean reverting type of financial metric, and that mean reversion point is in around that 16, 17 point mark. And when you say that, hey, the summer months are in that range, well, guess what? That means is not too much exciting stuff going on, not too much uncertainty, and there could be a number of reasons for that. One, it could be like a rally period. Two, it could be this lower volumes and people are deemed to be, oh, they want a vacation, not paying attention to the stock market, et cetera, et cetera. Where things lie, like absolutely, that's going to be very challenging to tell. But at the end of the day, that volatility number, taken in and of itself, kind of implies that, hey, listen, the market is at least staying steady or rallying just a little bit. And what is it rallying towards, right? That's when I was looking at this analysis, that's what I was really kind of seeing what is that light at the end of the tunnel, or maybe what is that volatility at the end of the tunnel. And we'll see in the next slides that volatility at the end of the tunnel happens in September, October, when things don't aren't as rosy as they were during the summer. Okay, let's continue on here. So here we see further support of supporting the trend of quiet to summer is the fact that realized volatility September through December averaged 15.9%, so a little higher, and the VIX averaged 20%, or almost 20.5%, right? So that's a pretty big pickup, right? And you know how much volatility can impact options pricing. So, we do see that. So what this is telling me is to say, listen, like summertime averages at 118 and a half. September to December, about 20 and a half. So it's a 2% pickup. So it's almost like we want to get kind of pre-positioned into the summer, experience potentially a summer rally, and then decide what to do in around August to position ourselves for September through to December. That's what this kind of analysis is telling me, right? Now, it does say here, this phenomenon is partly explained by the fact that many investors and traders take extended vacations during this time of year. Maybe that's true, maybe that's not. I do know this from a business perspective. I've been an entrepreneur for quite some time that August and also as an employee, August is a bit of a slumpy month. Like not too much stuff happens in August. People are going on vacation. People are looking forward to September to kind of hit the ground running again, back into the new year, back into the new school year. Kids are at school, etc., etc. Right? So we do see that August. I don't think it's any surprise to people, but August is a slower month in the summer. And then things pick up into September. So that may in part be a little bit true as well. Okay. Um, this is an interesting chart, guys. You've heard us say this a lot. What does history tell us? And I think we can gain a lot of interesting information. This goes back to 2000, right? So 2000 through to 2020, almost 2025. You can't really say what's in 2025 because we're kind of just about midway through that. You can see that this red line was investing only in May through October. Didn't get you anything really, right? Didn't get you too much, right? Well, I mean, if it's 29%, yeah, granted, but like, uh, if compared to the other returns, very, very interesting here, right? If you only invested in November through to April, you're at about, 210% back to 2000. And if you invested all year long, that actually gave you the highest rate of return of 299%, right? So and this goes back to the adage, it's like, not timing the market, but time in the market, right? Two very distinct uh, kind of phrases there, or catchphrases, I should say. Timing the market or time in the market, right? Oftentimes, we don't want to have cash drags, right? Where you just say, "Oh, I don't think things are going to be very good, so I'm going to take everything and put it into cash." We really don't do that because we don't know, and this proves it proves us there's a lot of historical significance saying, "Hey, you know what? You do need to be there to weather the storms in and out to pick up on that return, right?" And this is something that a lot of historical data here. This is not really telling you to like get out of the market at certain points in time or not. But again, this is a good reason to say, we do need to stay in the market, and indeed we do. We may have a little bit more cash so that we're ready to deploy, more heavily when volatility goes up. Absolutely, but that's something that we always maintain. Like we always have a cash balance that is healthy enough to be opportunistic, right? So, healthy enough to be opportunistic is an adage that we use quite often. It's like we don't want to be caught to say, "Oh, look, it's a lovely deal here, but we have no funds to deploy, right? So we're very prudent in that approach. If you look here, that hey, this May to October, so that's kind of exactly where we are now. That's a 1.9% return. This is since 1950. But that being said, guys, look at the returns like January to June. 4.3, basically fours across the board if you're holding, winter through to the midsummer, right? And indeed, November to April, the highest level of return. But again, you don't necessarily want to miss out on all the months, right? Because at the end of the day, all these months are actually positive, right? Now, you can divvy up these statistics as you will, but I think the take home here is let's not dwell on any one specific metric. But I think what we can take home is, hey, listen, cash doesn't really pay as well as equities, typically speaking. That expected value for equities, right? Which is the expected return, and that we do need to be prudent in our approach here to have cash to deploy and to be invested in the market. And we've actually done that. We'll show you exactly where the portfolio stands in the following slides, right? Okay. Any questions, you please let me know. As per Bloomberg, historically, the period from November to April tends to deliver stronger periods compared to May to October, although the summer months generally still post modest gains. Very important, right? I mean, personally, I don't really care if November to April is like is really, really strong. What I do care about is, hey, is it negative in those summer months or is it positive? If it's positive, I still want to stay in because I still want to stay in because it is a positive return. It's not deteriorating my capital, right? Um, invest exclusively from November to April generate 21%. But here, however, staying invested all year round, 299%. Clearly maintaining consistent market exposure outperforms seasonal timing strategies. Absolutely, right? We've always spoken of seasonality. It is a good indicator, but oftentimes it can be superseded by other macroeconomic factors, especially when it comes to ones that could be globally impactful, such as tariffs, such as COVID, et cetera, et cetera, right? And we've seen that 5 years ago in COVID. We're seeing it actually right now as well. Okay. Um, although historical patterns may encourage caution during the summer months, real world outcomes often defy that expectation. Take the summer of 2020. For example, despite early uncertainty by the global pandemic, S&P delivered a strong rally benefiting investors who remained in the market, right? So again, this hitting that point home. Um, so what may lie ahead? I think, the sell in May, it does have some statistical weight. However, maybe not as strong all the time. I think, me and Danielle, who's our analyst, and we were talking about this, and it's like, yeah, that sell in May and go away, certainly does hold weight. But that being said, it's like, it's almost like a watch out for August because September is next, right? And that could be a very bloody month, and that could go on for about 8 to 12 weeks potentially, right? And we've seen that actually, in the recent past, right? So now, what those triggers are, that could be different, right? Because I do believe that these market inclines and declines can be triggered by something, and often we often see that, right? For example, if you think that the sell in May and go away, if you saw a sell off in May, for example, and you just happened to see, wow, there's like skyrocketing inflation. Well, it's like, was that really a seasonal pattern, or was that a macroeconomic event that triggered a sell-off? I would tend to think that this is not a seasonal pattern. It is really a macroeconomic event that triggered a sell-off, and the two are really not all that correlated, right? So, you have to kind of sift through where the noise and to see what exactly the catalysts are here, okay? All right, on to the fund. This is for May 27th, and I should mention, I hope, this is kind of um, sifted out some of the noise around a summer rally and said, okay, well, the summer may not be that thing to be feared, but perhaps the fear is more about what's happening in the fall, in September and October, when people try and come back from holidays or for wherever they have been, or maybe even at work all the summer long, right? And come back and say, okay, well, there's a certain selling is going to be in order, right? That we have seen. Okay. So here we have in alphabetical order. Actually, it's not even alphabetical order. Maybe it is. Yeah, it kind of is. We have our largest holding is Microsoft. We're kind of pleased with that lately, followed by Tesla. Tesla, we still maintain a very cautious approach here. It is our second largest holding, but we are liking it more and more now that Elon is actually, quote unquote, divesting from Doge, right? Or Department of Government Efficiency, right? So we are seeing that, but we are monitoring this very carefully. We are happy with this allocation. There's supposed to be some news on the horizon in the month of June regarding full self-driving. We will stay tuned to what that is, right? Alphabet, Amazon. Uh, Still very strong holdings there. We are quite comfortable with that. Both, apparently Amazon has one of the highest AI spends across all the Magnificent Seven. Quite surprising there. We're happy with that type of allocation. Apple happens to be in the news quite a lot, guys, right? With the whole bring iPhone manufacturing back to America. And we do see that as a potential headwind, but we do think that might dissipate a little bit because that could take years and years and years to actually do. And by that time, there's likely going to be a regime change in the Oval Office. That we see potentially a stronger headwind of like, what are the additional features and innovation that are capable from Apple's iPhones? Considering Apple's iPhones are between like 40 and 50% of total revenue, it is a significant amount, and that's what we're kind of looking out for on that stock. AMD Meta Platforms, Eli Lilly. We're maintaining that kind of around 8.5% mark. We're happy with that semiconductor play with AMD and Nvidia. Nvidia did release earnings, I believe, this afternoon. And we'll have more to discuss on that in the days ahead. Um, Meta and Eli Lilly, we are happy with those positions, veering a little bit away from the semiconductor play with Meta, but a lot away from that semiconductor play with Eli Lilly. So we're quite happy there. Um, and yeah, Airbnb, we're in the process of divesting of that position, and we'll be continuing to look for opportunities to do so. And we continually are increasing our allocation to Bitcoin, not to a crazy amount. We'll see the desired level of exposure at 6%, not to a crazy amount, but to get that exposure in there, right? It is a newer asset class. It does have this kind of risk on, risk off feel to it. When you look at it, but, when things are very good, money flows into that asset pretty quickly, and when things go pretty bad, money flows out of that asset pretty quickly, accounting for a little bit of its price variability there, right? We always have a good 3% cash buffer, and sometimes even more, guys, right? To be opportunistic when we can, right? We don't want to be completely stripped out of cash because we want to deploy when volatility is high, when the prices are right. Okay. Let's continue on here, guys. So summary of fund position, guys. We have about 15 puts outstanding right now on different positions. That accounts for about 4% of the total portfolio. We have money coming in like literally every week, almost every day. We're very happy about that. We have some covered calls. We are very cautious in writing covered calls. Yes, we do believe in writing options, guys. Absolutely. The ability to generate return and wealth through writing options. That's fairly straightforward. A lot of people understand that, especially in the investment community, right? But in terms of writing calls, guys, we really want to be careful when writing calls, and we do abide by certain kind of thresholds to say, hey, what is our position sizing in total long, from a total long perspective versus, how many calls do we have on that position, right? And we monitor that pretty carefully, and we only write calls when we really think that the timing is right, when the macroeconomic environment is right, and when the fundamentals are correct as well. And of course, charting. So we are very careful along those lines, right? We have 12 positions that we were saying. Current long exposures, percent of AUM, about 81%, sorry, 91%, actually long stock. And long stock plus our puts, which are about 4.2%, that takes us to 95.6%, right? The total value of the option premium received is a percent of AUM year to date, 7.8%. That's a big number, guys, right? So constantly writing puts and calls, it does pay off in the long run here. We're very pleased with this number, and we do look at this number. We do keep these options expirations, especially because we're writing puts and calls, ready options in general, to a fairly low number, about 19 days right now, average. We may go out to 30 to 35 or 40 days, but definitely not too much. Almost never above that. Sub 30 has always been kind of our sweet spot. Okay. Um, just remember, guys, that some fun details. Yes, this can be put in your registered accounts, TSFA, RRSPs, riffs, etc., right? You can definitely do that. We do take it. It's $1,000 minimum, as you know. We do have packs. Lots of people have actually put in a contribution and added a pack, which is a pre-authorized contribution on a monthly basis. We're happy to have that discussion. Because of the nature of the portfolio, this is a tech-heavy stock with, innovation. I'd say sometimes I don't think it's tech-heavy. Sometimes I think it is innovation-heavy versus tech-heavy. So it is deemed as quote unquote high risk, and it is wrapped in an offering memorandum format. And yes, this should be a long-term investment. The people we take money from that want to invest in this product, they're okay having, weighing out the ups and downs and have a long-term kind of growth horizon, right? Again, we, open to portfolio managers, SMA accounts, accredited investors. As you know, I'm sure Omar or one of the team have been in contact with you. If they haven't, please reach out. Okay. So what to look out for next, guys? June is around the corner. I think June is on Friday. Oh, no, it's Saturday. June 1st is Saturday, right? I think. Um, and it's not considered a strong stock, but we have to play that against the backdrop of, hey, listen, we do have uh, some data to say that the summer's not all that bad, guys, right? And sometimes you do have a little bit of pickup in the first few days of June. We'll see how that goes. But at the end of the day, we are going to be looking for macroeconomic factors like tariffs and rate cuts in both the US and Canada to kind of drive the market forward, right? The seasonality part, yes, it is there as, part of the landscape, but it is not front and center for this year. That's not how we are seeing it for now. Okay. Guys, if you have any information, please call Omar Khan. He's a dealing representative. Myself, who I'm now the portfolio manager of record on this fund, and David Jarvis, who's the president of Cortron Capital, also portfolio manager, and we work together on this fund as well. Okay, guys. I do need to kind of put on the disclaimer. Um, just for a few seconds here, and I will invite, at this point, I'll open the floor to any questions. If you have any questions, please let me know. I'm happy to answer this. If you did want to listen to a repeat of this, guys, this has not been a long presentation. We want these to be, not necessarily short and sweet, but informative and sweet, right? It will be posted to our YouTube channel over the coming days. If you have any questions, please let me know. If not, I wish you a wonderful Wednesday afternoon and look forward to speaking to you again soon. Okay? Thank you very much, guys.